Hello everyone. In previous class we have seen about the structure of Indian financial system, and under that I have explained many things. So once again I am not going for the explanations of these particular aspects. See here, there are a lot of explanations which is simple. You can understand it very easily. I will send you this particular document. You can read it. Today we are going to speak about another new topic, that is development of Indian financial system and some important terms associated with the capital market. Then after we will speak about the investment process in the coming classes. So some important terms which is associated with the capital market are investors, examples shareholders, debenture holders, buyers of any other securities. Under investor, individual investor will be there. If one person is invested, then he is treated as individual investor. Under individual investor, risk taker is there. He is aggressive investor. He used to take a high risk. So higher the risk, higher the return. So if lost, the loss also will be higher. Then risk averse will be there. They are the defensive investors. They are not ready to take the risk. That means they are going to focus more on the security. Then institutional investor is there under investors. Institutional investors are the investors who invest through institutions. Okay. Then speculation. Speculation means taking the advantage of the price fluctuation. Under the speculators, bull is there. He is the person who is buying for low price and selling it to higher in the future. Bear is the speculator who is expecting the fall in price and selling the securities which he holds. Then lame duck is the person who is suffered severe losses. He is struggling to manage his financial condition. Then stag is there. He is the intraday transactor. Okay. So this is about some of the important terms in the capital market which you are already studied in your undergraduation. Let me go for development of Indian financial system. So it is started in the year of 1947. In fact, this is started in the year of 1934-35 when the Reserve Bank of India is formed. In the year of 1948, RBI is brought under the control of the government. Afterwards, the banking sector revolution is started. So in 1956, Imperial Bank of India is transformed and renamed as SBI, State Bank of India. And in the same year, 245 life insurance companies were consolidated and merged and become LIC under the government control. So this is the major change. In the year of 1964, UTI is established and PF and pension funds, provident funds and pension funds are established in the year of 1964 itself. In the year of 1969, totally 14 commercial banks are nationalized. In the year of 1980, 10 more banks are nationalized and general insurance companies are recognized under General Insurance Corporation. So one particular department is formed to look over the general insurance companies. From the 2019 onwards, government is planning to go for some of the structural changes. Many nationalized banks are merged here and the process is still going on. Instead of 22 national banks, they are trying to make it for 8. For what reason? They are trying to centralize the resources. So this is about this particular class. In the coming classes, we will go for the investment process, which is very important, and surely that will be your question for your externals and even for the internals.